Did you think the more dividend stocks you own, the more money you would eventually make? Well, that's just an outright lie. But a lot of people actually fall trapped to it. Personally, I will shamefully admit to making this very mistake very early on in my investing career. And I mean, if you really think about it, the logic is totally there and sensible. The more stocks I would have in my portfolio, the more dividend income or dividend paychecks rather would come in on a monthly or quarterly basis, which then ultimately means the more money I would be sitting on at the end of the day, at the end of the month, at the end of the year, right? Wrong. Now, if you're not careful, you will actually make less over time if you are busy spreading yourself out way too thin and without the slightest of clue as to what really happens when you are essentially just creating your own index. So in this video, I'm going to go ahead and break down this whole more is more myth, run some numbers by you, and then actually share two of my favorite monthly paying dividend investments that have just been unstoppable since their inception and will likely continue to dominate their way to higher highs, which just means more of an ROI for all of the shareholders like yourself if you actually choose to get invested in them. So let's just start with what I call the Dividend Fool's Gold portfolio, comprised of dozens upon dozens of stocks or hundreds of holdings. Now, we are all always told that diversification is key to ensure that we create this buffer against volatility. Now, diversification does not necessarily mean more. That is a total misconception. A matter of fact, in Peter Lynch's book, One Up on Wall Street, the legendary fund manager introduced the term of diversification to describe what I'm actually about to talk about. But if you're more of a Buffett fan like me, well, the Oracle himself once stated that diversification may preserve wealth, but concentration builds wealth. These are both essential takeaways that I want you walking away with. So when I think about what both of these two Wall Street sages really meant, it's pretty simple. Keep your portfolio concentrated. A matter of fact, the more concentrated it is, the better. Don't load the boat on various dividend stocks just to obtain this diversification idea, but rather choose the highest of quality stocks across sector verticals to really achieve concentrated diversification. Why is this so important? Well, so many of us are really only earning an average salary, if that, and can actually only then invest a certain amount of money into the market on a weekly or a monthly basis. Now, with that average salary in the United States being around $65,470, according to recent data from the Bureau of Labor Statistics, we then have to go ahead and take out taxes because no one escapes Uncle Sam. That brings us down to $58,389 roughly. And if we divide that by 12 months, we're going to get $4,865 in take-home income. But then we have rent and bills, groceries, personal spending habits, and all the alike, which really means that we only end up with, say, $500 to $1,000 a month to actually invest. Now, trust me, I think even that's pretty generous for the vast majority of us retail investors. But we then have to run the numbers, which means for those of us investing, say, into 30 stocks, our $500 to $1,000 isn't going to get us too far in terms of dividend income. I mean, as you can see, whether it's $16 invested per stock monthly with $500 or $33 invested with $1,000 a month versus, say, squarely focusing on just 5 to 7 holdings every single month, which then allows for you to likely buy a full share with $71 per stock or with $142 per stock. We then ultimately come around to doing our dividend yield math, and we will find that earning a 25-cent dividend is not only going to be demotivating, but likely just isn't what we really drive for in terms of returns. And of course, if we're really trying to hit financial freedom, that's not going to move the needle. So I say less is actually more. That's what diversification is all about, as long as you're concentrated in certain positions across sectors. But what the heck does this all have to do with monthly dividend income and just generally making more money every single month? Well, here's where two of my favorite monthly paying dividend investments actually come in. And I'm going to give you this little strategy to go along with these investments. And no, they aren't individual stocks, because the reality is picking individual stocks may be an investor's biggest mistake if they aren't on their A game when it comes to actually researching or having an interest in spending more than just 2.5 minutes to actually keep up with the company and how these companies are performing or what exactly they're doing. Therefore, I say boot the dividend stocks, the individual dividend stocks from your portfolio entirely, or just stick to your top 5 before doubling down on exchange traded funds, which will allow you to just then invest into a basket of holdings, thus alleviating your stress and, more importantly, all of the pressure of actually picking the winning stocks 100% of the time. Impossible. After all, even most of Wall Street's top dogs can't do that. That's where we come to ETFs. Now, with that, I'm going to suggest that after you have your fund with a handful, just a handful of high conviction individual stocks, you scale positions with monthly dividend ETFs if you're in some serious need for monthly dividend income. As for the first fund, I think it's worth every investor's investment. We have the JP Morgan Equity Premium Income ETF, ticker symbol JEPI, which seeks to deliver monthly distributable income and market exposure with less volatility, but it also maximizes its dividend income and deliverability there by using a very disciplined options overlay strategy with written out of money S&P index call options that generate that monthly dividend income for you. Now, this particular fund hit the market back in 2020, so it's relatively new, and since then it is actually just performing very well. As you can see now on the screen, we're up year to date nearly 4%, and then on the 5-year chart here, we can see we're up by over 18%. But what exactly makes this fund so powerful? Well, it's the fund's makeup. So clicking back into JP Morgan's fund profile, I want to go ahead and scroll down with you to find how this one spreads out across sectors. To find our bases are covered, with sectors like technology coming in at 14.4% of the fund's weight, followed by financials at 14.2% of the fund's weight, and then we have healthcare and materials, that's 12.7% and 12% respectively of the fund's weight, consumer discretionary there at 9%. But this leads us then to holdings like Progressive and MasterCard, Visa, AbbVie, Meta, Amazon, Analog, the Southern Company, NVIDIA, and Trans Technologies, all working together, coupled with the option strategy, as I mentioned, to deliver through on reliable dividend income on a monthly basis, with a dividend yield coming in over 7% at 7.12%. Now, what does that look like with, say, a $10,000 investment if you had invested $10,000 since the fund's inception? Well, you would have enjoyed an average annual return rate of 13%, which would have gifted you then with an extra $7,898.70 back in your pocket. But if you're really looking to rev up your monthly dividend income for the future and really concentrate yourself into really one sector that our future revolves around, it's going to be this fund's sibling fund, the JP Morgan Nasdaq Equity Premium Income ETF, that's ticker symbol JEPQ, which has the same options overlay strategy. Yet this entire fund is tech oriented. As we can see here, the fund seeks to deliver monthly distributable income with Nasdaq 100 exposure. Now scroll down with me to actually find the sector spreads across here. 40% of the fund's weight in technology before diving into communication services, and then consumer staples. Those come in at 12.7% and 12.1% respectively, which then work out to a ton of tech holdings: Apple and NVIDIA, Microsoft, Amazon, as well as Google and Meta, Broadcom, Netflix, Tesla, and finally we got Costco as the 10th largest holding within this fund. This powerhouse of a fund will drive monthly income your way with a dividend yield coming in at a staggering 10% as of this video. But if you threw in $10,000 at the date of inception of this fund just back in 2022, so it's even newer than the last one, you would have enjoyed, well, 17.7% worth of an average annual return rate to reap $5,803.41 in profit. However, you may now be thinking to yourself, well, I don't know. I think picking individual stocks is just better. Assuming you went with, say, the safest of the safest monthly paying individual dividend stocks on Simply Safe Dividends, comes down to Realty Income at 5.7% of a dividend yield and Agree Realty at 4.1% of a dividend yield. Well, we'll find that JEPI and JEPQ both outperformed those two individual stocks over the course of the long term. And more than that, with an ETF, you're not just going to get more comfortability in terms of not needing to pick the winners 100% of the time, which is, like I said, impossible, but the dividend yields come in more than double that of individual dividend stocks. So with that, I now want to know all of your thoughts on diversification or diversification, and if you're invested into monthly paying dividend ETFs, and if you are, if they're similar to JEPI or JEPQ, or if you have better dividend paying ETFs in mind that pay on a monthly basis. Let the entire community know down there in the comments. I want you to go ahead and tune in right here if you haven't yet hit your first $100,000. This video is going to help you get there much quicker. Make sure you're subscribed, and with that, I'll catch you all in the next one.